Another big one that I really like, which is always the argument I get against this data mining, is that if you just try enough combinations, you'll find something just by pure luck. Like something will pass the in and out of sample testing. So what I like to do...
Better System Trader, episode 79.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Well, hello there, it's Andrew Swanscott here, and welcome to another episode of the Better System Trader podcast. Glad you could join us. With the toolsets we have available to us today, it's really quite easy to create a trading strategy by just mining the market data. And as we've just heard in that opening bit of audio, and also from previous podcast guests too, if you try enough combinations, you can find something that appears to work just purely by chance or by luck. The challenge, however, is trying to find something that could be sustainable. Something that may persist long enough in the future for us to take advantage of it and hopefully make some money from too. Our guest from this episode, Dave Bergstrom from BuildAlpha, has spent years researching, building, testing, and implementing market making and trading strategies for a high frequency trading firm and also for CTAs, money managers, individual clients, and even aspiring retail traders. In this episode, Dave is going to share some of his insights into strategy development and validation, including how adjusting the ratio of in-sample and out-of-sample data can lead to creating different types of strategies, variance testing, what is it and how can it be used in the strategy creation process, how E-ratios can be used to determine how an edge decays over time, and also to weed out potentially poor strategies even when they have a good-looking backtest results. He'll also cover why volume and volatility are important factors to consider when building trading strategies, and loads of other ideas to test and validate the robustness of trading strategies. So let's get straight into this chat with Dave today. I hope you enjoy it. Hi, Dave. Thanks a lot for joining us today. It's really great to have you here on the show.
Hey, Andrew. Thanks for having me.
Now, I just wanted to start today by mentioning that you have actually been on a couple of other trading podcasts in the last few months, and they were great interviews, but I think that there are a couple of points that you made in those that they kind of either got missed or they didn't go into them deep enough. So it's really great to have you here today, and I hope you don't mind that if we drill into those points a little bit deeper. So are you cool with that?
Yeah, that sounds great. Let's dig.
Awesome. So before we get into that, though, how about you give us a little bit of your trading background?
So my trading background started probably in undergrad, where I just kind of picked it up as kind of an excuse to, some other reason to not take the current path I was on. So I think I started like a lot of the typical retail trader story, the chat rooms, the online, websites, information, the podcast, what have you, and wound up lucking out a couple of years into my journey where I actually got to take a job as a trading assistant at a HFT firm, high frequency trading firm, which kind of led me down this path where we're talking. So now, I kind of went from the typical retail trader of, drawing lines on charts and, you name it, all the books will tell you. And now it's, fully systematic, self-taught programmer, much different approach, if you will.
Yeah, okay. So can you give us a little bit more information on this systematic approach and, how do you approach strategy development these days?
Yeah, so what I was realizing is there just was no way that I could put my hard-earned money into the market without having, the statistics, or the information that I wanted for confidence. So slowly but surely, you start building simple things in Excel or whatever, and then I realized, I needed, more information, and you wind up learning these, even like the proprietary languages for the retail brokers are fine, but I wound up learning C++, which lended its hand to much deeper research. And then from that point, everything I was doing is systematic. And then I came to this point where I realized, I'd have an idea, and I'd test it out, and then, sure as, the day comes up that it wouldn't work. And then you got to think of another idea, test it up, doesn't work. And you go through this process and you're almost doing it like a dinosaur. So I, evolved into, this idea. It's actually I think in machine learning, technically it's called the genetic program, but what it does is it's basically, an enormous search program. So I really have, no problem. I know it gets a bad rap, but I really consider myself a data miner, if you will.
Yeah. Okay. So I think if you're using a data mining approach like that, though, and you're leaving it up to a computer to decide on the trading rules, that can be prone to abuse, like overfitting, because you're kind of removing the human elements from the process. So what steps in the strategy creation process do you actually take to try and prevent curve fitting and other things like that?
Well, first, I'd actually argue that the human bias, I actually want to remove that. I think that's caused me quite a bit of trouble when I was starting out. I think, how can I say this? I think there's a lot of market axioms that you hear when you get into trading, things, general truths that you'll hear from the TV all the way to, Twitter or some trading textbook. And when I started programming, you would test all these ideas out, and I can't remember which one was the final straw, but I want to say it was one that had like, bearish in the name, like bearish engulfing candle or something. And
Yep.
It turned out to be, like whatever my test was, it was like 8 to 10% better than the opposite, the bullish engulfing candle. And at that point, I kind of realized I wanted to remove this human bias. But I absolutely agree with you. I think that obviously this data mining approach, or this multiple hypothesis testing, if you will, it does lend itself to curve fitting quite easily. So you do have to be very precautious in what you do. So I think even before getting into the validation techniques, which we can probably get into in length, there's some things I like to do, just even the way that I like configure my tests. So like I won't allow strategies that have that don't have a certain trade to parameter ratio. Is like a really simple one. Obviously, out of sample testing is huge. Even allowing your out of sample period rather to be greater than 50% of the data. Sometimes you test or train on the you'll train rather, on 30-40% of the data, and then you'll test on 50 to 60% of the data, 60-70% of the data. You could do randomized out of sample testing, which I think we can get into later. But another big one that I really like, which is always the argument I get against this data mining, is that if you just try enough combinations, you'll find something just by pure luck. Like something will pass the in and out of sample testing. So what I like to do, and I actually stole this from, at least I made a variation of it, from Jeffrey Woodruff from Hedge Fund Market Wizards. I think it's chapter 5. But he essentially mines the data, random data, and creates basically a baseline of, like what's the best I can do on this data set with random signals or random data. And that serves as, the threshold. So if you mine real signals on real data, and you're not beating that threshold, then you can immediately throw this stuff out. Because you're not even, if you're not even beating the random signals or the random data, then what you found is, your fear that you found it by random chance or luck. So that, I think those are like some of the simple ones just to, even configure the test. You can kind of lower the odds of curve fitting.
Yeah, okay. You raised a couple of good points there, which we'll get to in a minute. But if I can just jump back to this trade to parameter ratio that you mentioned, obviously, if you're looking at that, then you're having a bias towards a least number of parameters in a trading strategy. So when you look at indicators that have parameters that can be optimized, do you kind of like to exclude those type of things, or how do you manage that in a trading strategy?
Yeah, I generally don't like to use indicators. If I do use indicators that have a look back parameter, for example, like RSI as one input for length, I generally don't optimize that length, because you run into all of these I guess new assumptions on, okay, well, if I use the 14 RSI and that works, well, then maybe I should fluctuate that 14 and I need the neighboring parameter settings to also work. And it's like, well, how many are considered neighbors? Is it 10% to the left and 10% to the right? Is it, and how do we define, good performance? Do they just need to be profitable, or do they need to be X percent of the net P&L from the 14 back test? So I generally like to just, if I'm going to use it, I just use basically like the default setting. If that works, it does, that's fine. If it doesn't, I'm not going to go ahead and change a bunch of, parameter lengths, because I think that does, that kind of just increases the odds of curve fitting. And that's generally not what I want to do, because I'm already flirting with disaster, if you will.
Yeah. Just a little bit more then on your trading approach, because I noticed when I was looking on your Twitter feed, it tends to be a lot of focus on volume and volatility. Are they kind of the main focuses that you use when you're developing strategies, or is there more to it?
Yeah, I think those are probably the two most important things. I mean, it's probably tough to pull just straight out of context, but yeah, I think if you're not looking at least volatility, it's tough to create expectations that I can actually use or be, if I don't know the volatility, or at least an idea of how much a market should move in some given amount of time or bars, then I find myself I think I find myself in a lot of trouble. So volatility and volume definitely high on the list, if not the top.
Yeah. Okay. Now let's move on to data. And you've just kind of mentioned how you like to split in sample and out of sample data, and you adjust the ratios there. So can you explain a little bit more about the drivers behind that, and what type of results do you find by adjusting the ratios?
Yeah, so when I first started system testing, I would always use basically 20 to 30% out of sample, and it would always be the last 20 to 30% of the data set. And over time you start to realize, well, what if that last 20 to 30% was an extremely favorable environment for this type of strategy? And so then you can kind of do some stuff, or maybe you want to train on that last 20 to 30% of data because that's the most relevant data because it's the most recent. So I started to mess around with, maybe I want my out of sample period to be the very beginning of the test set. So I would basically train on the last 70% of the data and then use the out of sample as the first 30%. And now I'm kind of at this, it kind of evolved to this, I'll fluctuate the window and kind of run the same tests over. And I'm realizing that I'm finding different trading strategies depending on how I set that window. And that's obviously because of, kind of where I'm putting the cutoff. And it could be in the middle of a favorable market regime. It could be at the beginning of a favorable market regime. And it's so this introduces another problem, if you will. So my current working solution, if you will, is to almost select random out of sample periods. So and they don't even have to be continuous now. So instead of selecting some middle chunk, some middle 30% of data or some 70% of data, I'll actually pick, like this chunk here, this chunk there until I get to whatever percent I predetermine as my out of sample percent. So I think that it's just kind of an extra test or precaution. And then obviously I want to rerun that test over and over in case I, by random chance could have randomly selected a favor or created a random, favorable market regime. So it's always something, you change one thing and you introduce some new, problem. So I just try to think of all the problems you're getting rid of and the problems you're bringing in, and and hope at the end of the day that you've kind of accounted for as many as you can, and that's where I'm currently at in my research.
Yeah, I think that's an interesting approach of randomizing the data sets a little bit there, because it is very easy to find a strategy that works great in optimal solutions, but obviously that doesn't really happen in real-time trading. But if you're looking at you're creating strategies that are working in the best market regimes, if you decide to perhaps take that into real-life trading, do you add some market regime filters into that to kind of keep it switched on during the best times?
Yeah, if I can uncover those market regimes in the in-sample data. But if I can't look at the out of sample and then go back and obviously add some market regime filter because I've already seen the out of sample results and I'm a bias then. But yeah, I think market regimes are definitely something that I look at and I think are extremely important to understand. It's all about gauging expectations, and those tend to do quite well with that if you can find ones.
Yeah. So what type of market conditions are you looking at? Like, how do you define market regimes?
I think like a simple one, without giving away, any of my sauce, but I think like going back to volume and volatility, if you look at those two, you can kind of create 4 simple regimes. You can have, increasing volume, increasing volatility, and then obviously decreasing volume, decreasing volatility, and then you can have them, mismatched. So that, that could be, a good starting point. And is something, I looked at quite extensively, for a long time, and still, it's always part of like my search process, even today.
Okay. So you've mentioned some steps that you take during the strategy creation process to kind of prevent overfitting and things like that. But what about after you've come up with some strategies? Now, how do you actually validate or test them for robustness? What kind of techniques do you use?
I think the simplest test is looking across markets. That's like obviously you have more confidence if a strategy works across similarly related markets. And then second, I have a handful of, well, actually, even before I get into that, I want to mention so in my own testing, I want to bring up E ratios, which is or edge ratios, which essentially is the normalized favorable movement divided by the normalized adverse movement post signal. So basically, this is an idea of how much edge, can be realized after a signal. And maybe I can like link a calculation or something for this. But to me, I found in my research that if I had strategies that had really positive, like backtest results, if you will, and even out of sample results, but if they had basic negative or unfavorable E ratios, they would always fail. So to me, like a really good test is, it has to have a positive E ratio. So even if it has a great back test, but a bad E ratio, I'll throw it out right away. And then, moving on, obviously the test, you can do, a variety of Monte Carlo tests, just the simple reshuffling of trades. You can do, I think I talked about the random out of sample I do. You can just look at like even versus odd days, the performance on those to see if, that does anything. And then, I really like, it's essentially like, I call it like a noise test. So what I'll do is I'll add varying amounts of noise to the historical data, and then I'll go back and retrade the strategy on the newly created noisy data. And sometimes it's less noise, sometimes it's more noise. It's basically a random noise. I don't know how to, adder or subtractor. And if the strategy, seems to be, hold up well with differing amounts of noise, then to me that just, another way to lend confidence that it's not overfit to the exact price data, but it's, robust.
If I can just jump back to this E-ratio idea, I just want to make sure that I got the concept right. So are you saying that you're looking at the ratio of the maximum favorable excursion and adverse? Yeah, that's it.
Yeah. I did almost do the same thing.
Oh, okay.
So essentially what it is so you look at like the origin of the signal, the point of the signal, and then you'll look, okay, after 1 bar, what's the average normalized for volatility, favorable excursion, divided by the normalized for volatility, average adverse excursion. And then you'll just do that from, 1 to n bars from the signal. So let's say that your trading has like a maximum hold time or like an average hold time of 5 bars, but you see this E ratio fall off the cliff after 3 bars. It just kind of gives you a sense like, hey, maybe I don't want to hold for 5 bars because the edge goes away. So yeah, it's just another measure to kind of see how much edge plays out after the signal occurs.
Yeah, okay. That's interesting. I've never heard of that concept, so thank you for sharing that with us.
Oh, okay.
Now, so you've discussed Monte Carlo. Now, there's something else. You've been working on a trading tool or an application, which we can discuss a little bit later. Now, I noticed I've been playing with a trial of that. Thank you. I noticed that you've got variance testing in there as part of the, the validation process. So, can you explain a little bit about what that is and how you use it?
Yes. So, a big thing for me is I need to be comfortable with the possibility of outcomes over the next N trades. So I've came up with this idea of I basically want to simulate where the strategy will be, N trades into the future. But what I've created is the ability to vary the win rate of that strategy. So as I'm simulating it, I can simulate it with lower win percentages, because the idea with this is I've always found that whatever I find in my research tends to be less than I thought in live trading. So even if it still works, it's just always not as good as I'm almost always optimistic in my research. So this variance test allows me to lower the win percentage and see if the strategy winds up with live trading a win percentage down here, 5% lower or 7% lower, whatever I set it at. Is it still? Am I still comfortable with the possibility of outcomes? So it's just another check on if the market doesn't act exactly as you think. Are you going to be okay with the risk you would be assuming in that environment?
So when you're doing this variance testing, you're actually taking trades from the backtesting population, or are you generating phantom trades to make that variance fit to what you want?
Yeah, so I'm basically creating a probability distribution from the backtest results. So, and then I'm pulling essentially phantom trades with a quasi proprietary Monte Carlo Markov chain method. So it's pulling random trades and then deciding if that phantom trade should be accepted or not in the simulation. So it's kind of maybe complex, maybe not, but it's basically just a resampling.
Yeah. Okay. So I think you just mentioned there that you're looking at variance perhaps from a win rate percentage, but what other metrics would you look at for variance to give you a bit of an indication of the expectation?
I think it depends on what I'm using. So the way that I data mine, if you will, I pick ahead of time a fitness function or an objective function, and oftentimes maybe even multiple objective functions. So I think it depends on, like any of the comparisons or variance tests I'm doing would depend on what I've selected to build the strategies based on. So if I build basically a strategy or strategies that I know will have low win rates to start with, obviously, lowering the win rate doesn't make much sense from like the variance test perspective. So it all depends on the fitness function and the strategy characteristics.
Yeah. Well, I was going to say, so typically strategies that have a low win percentage are probably trend following strategies. So it's probably not realistic to change the win percentage to a high one, because then that doesn't match a strategy. So
yeah, absolutely.
Yeah, it's important to take into account the type of strategy that you're testing on.
Yeah, right. Yeah, right on.
Yeah, so so a little bit more on this fitness function then. Do you adjust the fitness function for the type of strategy you're looking to get, or how does that play out?
Yeah, you can do it that way, I guess. But I actually am kind of into this idea, and I think I heard it maybe mentioned on your podcast from somebody. But they talked about an idea of creating a portfolio of strategies based on different fitness functions. And it's kind of been an idea that I'm in the beginning stages of researching. But I think with, the advances in software and technology available to everybody, that, eventually almost everyone will data mine when they realize that, everything's data mining. Whether you have the idea and you test it and then you think of a new one and you test it, that's data mining just slowly. But this idea of data mining and then in changing fitness functions, it does create much different strategies, even given like similar sets of signals. So I think, and oftentimes even, it uses much different signals for the same market. And that can kind of, easily lend itself to creating portfolios for markets of uncorrelated strategies. So it's something I'm kind of, it's not fully developed, so I might kind of just sound like I'm rambling here, but that's kind of where I'm at and moving forward with.
No, that's fine. So what approach do you use now then, if that's something that you're looking into to create portfolio strategies? What's the approach you've used now or up to now? How do you build portfolios?
Well, most of my active stuff is based on Sharp. So I use the Sharp ratio as my fitness function. Just point blank, no big empirical reason why. Not, I haven't really tested that strategies built on Sharp ratio perform better than strategies. When I use some other fitness function, it's just personal preference, which is, now that I say it out loud, it's probably something I should test.
Yeah.
Yeah. The only other thing is that I kind of like also I'm looking at is like testing your test methods. Like, how do you know, like when you look at a Monte Carlo, test, how do you objectively say that yes, it passes this test or no, it doesn't? And do you have research on that? Because I think, it's a lot of times all these quants and system traders, they'll just eyeball these tests, myself included. And that's something where I'm kind of trying to put together some research on, like drawing the line objectively. Does this pass? Do I throw this strategy into the, the next stage of production, or do I discard it already? So that's.
Yeah, I think that's an interesting idea, because you've already kind of touched on a couple of points on like techniques to manage expectations. So you've got the Monte Carlo, and then you got a Monte Carlo plus noise, and then you've got your variance testing. I think, that sounds like some good techniques to manage expectations. But do you come back later on after you actually traded it live for a while and see, how did it actually play out compared to how you thought it might play out? And that kind of touches upon the point you just made about testing your test process.
Yeah, and that's an area where I don't have enough research, because it's something that I haven't realized until, you've been trading long enough to get the sample size of, because you build a strategy with, and you don't even think to keep track of the Monte Carlo, results that you used the time you decided to put it live, or whatever test you used. And now it's like, you have to you can't just have, if you have 5 strategies live, even if you have, 100 trade, or 1,000 trades or whatever on each strategy, that's not enough to say that those 5 strategies that passed that test in this way were enough. because that's only 5 to validate that test. So it's tough to get enough data to kind of create these like objective tests for the tests.
Yep. Okay, Dave. Well, just before we start wrapping up, at the start of the interview, you mentioned that that turning to the systematic approach kind of turned your trading around a little bit. But have there been any other kind of key insights on your journey that have really made a huge impact on your trading and the results that you've been getting?
Yeah, I think creating, well, one, testing everything, and then 2, creating, like we've talked, realistic expectations. I think, most struggling traders, myself included, and I was, getting into it is I couldn't answer the question of where am I likely to be in end trades? And it's much more complex than the average trade times N. It's a distribution, and to think in distributions is, that, once I was able to make that, flip that switch, that's kind of when things turned. And now it's, everything's a distribution. I really don't care about, a single back test. Let's simulate it out, and create that distribution.
Yes, you kind of already touched on this a little bit already, but how do you determine the point where you stop trading a strategy? Like when is it broken enough for you to say, I'm not going to put my money on that thing anymore, and I'm going to move to something else? Because expectations, you can get wide bands when you do a variance test or a Monte Carlo test. So whereabouts in that band should you sit before you cut it? So that's enough. So how do you decide that?
When I can't sleep. No. But I mean, that is part of it. I mean, that plays into it, because usually, your gut's kind of right in that sense that you probably should recheck your calculations at the very least. But yeah, I mean, I think like, the 95% confidence bands, that you can basically generate through, even like a simple Monte Carlo reshuffle, but there's some more complex methods. But I think all of those, if you're starting to get, anything that's kind of out of line with where your expectations were, is definitely where, I'd probably at least start debating pulling the plug. I've been fortunate enough not to have to do that too often, so don't have I guess a large enough sample size to tell you, knock on wood. But yeah, that I think all those tests are spot on. I mean, I'd be curious if somebody has better methods, passing my way. That's always something. You could, when to turn a system off that's the system trader's nightmare, right?
Yeah, absolutely. All right, cool. Thanks, Dave. Now I might start wrapping up today with a few quick closing questions.
Okay.
What's the biggest lesson you've learned through trading?
To test everything. I can't believe anything you hear or read. I have to test it on my own.
Absolutely. And how about trading advice? So what's the best trading advice that you've ever received?
Test everything? Can I use it again? Yeah, I just test everything. Creating realistic expectations. I think I got into it at that kind of age where it was I thought that I'd have a Lambo in a week, and and now it's I realize that it's a business, and people work extremely hard at this to compete with me. And it's you have to have realistic expectations or you'll be in for a rude awakening.
Yeah. I think a lot of expectations become more finely tuned over time after you've had a few beatings in the market. And
yeah, absolutely. It's
not so easy.
Right.
Okay. And what's your favorite trading book or books? Oh, man.
I mean, the hedge fund, all the market wizards are excellent. I like cybernetics of trading systems or trading strategies. I know it's he's actually a podcast guest, Murray Ruggiero. Yeah, I really like that book. And I think in the Bible, the trading systems and methods is one that I can't forget.
Perry Kaufman.
Yep.
Yeah, cool. All right. And also, what's the best way for listeners to get in touch with you?
David at BuildAlpha.com or on Twitter at dberg, DBURGH.
Yeah, cool. All right, I'll have some links to those in the show notes page as well, so people can find them. Now, I just earlier in our conversation, I mentioned a tool set that you're currently working on. People are probably going to wonder what I'm talking about there. So, do you want to just give us a quick little rundown of what that is, so that people are aware?
Yeah, so it's BuildAlpha. It's a trading software that essentially does almost everything we've kind of talked about, I guess, today. And so basically, you can kind of do this enormous search, and strategy generation with no programming skills. And then you can kind of go through all the validation techniques that, you'd like. And then if strategies that the software builds pass the tests that you run it through, which are all pre-programmed, then you can actually generate exportable code for a handful of brokers. So, hopefully it's a quant replacement, if you will. It's a tool to take you from no systems trading strategies to hopefully a portfolio of profitable ones.
Yeah. Okay. Will people be able to get access to that soon? I know you're still working on that now, but
by the time this airs, it should be good to go.
All right. Cool. Awesome. All right, well, thank you very much for your time today, Dave. It was really great to have a chat to you about a lot of that stuff that we mentioned. So is there anything else that you'd like to mention before we wrap up for today?
No, thanks for having me on, and hope I could add some value back, because I know I've pulled tons from your podcast. So thank you.
Awesome. All right, cool. All right, cheers. Thanks, Dave, and all the best with your trading, and we'll catch you again soon. Cheers.
Thanks. Take care.
Bye. Okay, so a big thanks to Dave for spending the time to chat with us today. Now, Dave shared a number of ideas and techniques that he uses in the strategy creation, validation, and monitoring processes. And one of those was the concept of E-ratio. Now, if you'd like to know more about that, like how to calculate it and what it can tell you about Trading Edge, then Dave has put together a special article for us explaining it further. So if you want to check that out, I have a link to it on the show notes page at bettersystemtrader.com/79. And also, if you'd like to check out the BuildAlpha software, I also have a link for that on the show notes page, along with some additional links to books, and you can also download a copy of the transcript there as well. So head on over to bettersystemtrader.com/79 and you can grab it all from there. Anyway, that's it for another session of the Better System Trader podcast. We'll have something more for you next week, so I'll catch you then.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.